You can do a lot of things with $1,000. Just imagine if you have a consistent stream of $1,000 every month just by doing nothing. Does it sound too good to be true? Chances are it is, unless you're willing to learn how to do it right. This is Income Intelligentsia, real-life advice for practical and financial goals. What we're proposing here is through dividend investing and how you can build a portfolio that nets you a good stream of passive income starting from scratch. Let's get to it. We want to dig deeper and get into more specifics when it comes to dividend investing and how it should work for you. Why? Because we feel that investing is something that allows you to build wealth on top of what you're currently doing. Sure, you can keep working until you retire, and there's nothing wrong with that. But if you're someone that's interested in making wise decisions with your money and letting it accumulate value for you instead of just sitting somewhere, dividend investing is your best friend for that. By regularly getting dividends, you have access to spending money apart from what you normally do in your day-to-day that you can reinvest and then compound so that you gain more dividends the more you invest. The reason why you want to do this is because your money goes up in value the more you invest it. Over time, the added value compounds and your investment significantly grows from what you initially started with. What you need to understand here is that if you divide the annual dividend by the current stock price, you get the dividend yield. Let's say company A has a stock price of $20 with annual dividends of $1. That would mean that their dividend yield is 5%, meaning for every share that you buy with $20, you get $1 annually. If you reinvest that money and the dividend yield remains the same, you can get $1.05 annually. Once you gain your dividend, you can choose to reinvest it to further increase the amount of dividends that you can get. It's a continuous cycle that you can do in order to gradually maximize your gains. Now that we've covered the general idea of how this is going to work, we want to know what we actually need to look for when we invest our money into. You can't just find any random company and then just throw your money at them, expecting to maximize your gains and retire from there. No, we've outlined 3 things to look out for when putting your money in a company and why they're important. The first thing we want to look out for is if the company has grown over time. For this one, we want to point out that companies that grow over time are ones with a proven track record that they'll stay in business for a long time. They've gone this far because they're doing something right, and it's your duty to make sure that you know why and how far they'll go. It's your money that you'll be investing, so putting it in a company that you know you can rely on, has longevity, and has stability is a great way to ensure that you'll maximize the period of time you'll be earning from them. If you understand their industry and business model, you'll also have a better idea of how much value they contribute in their fields. Some companies are more stable than others, and most of the time, they also tend to have higher dividends. One key thing that you need to know about knowing their model is if they're transparent enough about their finances. If their management style works for you and you feel that they're successful as a result, it wouldn't be a bad idea to invest in those companies, as good leadership can oftentimes push a company forward and raise their company's value. That being said, having a company's value increasing is not enough, as you also want to check whether they're beating their competition. If you're investing in a company that's at the top of their industry, chances are you're expecting them to stay there, and it's a good idea to find stability in what you're investing in. While it's not the worst thing to invest in others, choosing to invest in a company that's historically outperforming other stocks means that there's data backing your decision in your investment, and that you can rest easy knowing that it's in good hands. Apart from having a good track record, the next thing we want you to look out for is a company with a good price to earnings or PE ratio. A PE ratio is essentially a metric used to evaluate the relative value of a company's stock. What it means for you as the investor is that the lower the price to earnings ratio, the better it is for you in the long run. That's because the lower the ratio, the cheaper that you can get the stock for the same amount of dividends that you would get otherwise. For example, if a company has a PE ratio of 25, Investors would need to put in $25 for every dollar of earnings per share. Experts say that a good average for a company's PE is around the 20 to 25 range. However, for companies that exceed this, it's possible that the overvaluation is justified. It may have strong growth prospects waiting for it on the horizon, or it could have something new in store that opens up new businesses in the future. Companies with lower PE ratios are easy and cheap for what you can get from them, but generally they would also suffer from possible business issues and may get into financial problems sooner or later. While you get more money for what you've invested, you also run the risk of their business going out, or perhaps their whole industry isn't performing well enough for it. While you get more bang for your buck, the lower the PE ratio is, it's also important to understand the context behind their industries and why that would be the case. It's possible that they're in a developing industry and have yet to generate enough attention. Generally, knowing more about the market's conditions, growth prospects, and overall industry is beneficial to checking whether or not their PE is justified or not. Now that we've talked about dividend ratios and their PE ratios, let's get to the part where we know how long we'll continue to get money through dividends. Last but not the least, what you want to look for in a dividend stock is the company's history of earnings. This is where you actually get your dividends. Once the company earns money, most of what they earn goes directly to their investors. A company that you need to look out for are the ones that have a history of earnings, mainly because it indicates that the company is well managed, is financially stable, and is able to maintain their revenue stream consistently. What you want to be looking out for here are the company's financial statements. Get to know how much they earn throughout the years and months. It's always a good sign if the company continues to break their own records in terms of revenue. You'll be able to rest assured that you'll be getting more out of your stocks too. If the company also has a positive dividend track, meaning they're able to continuously pay dividends to their investors, you also benefit from the security that you'll continue to get paid. Checking their earnings per share or EPS also helps you out in assessing whether the company is profitable. A steady growth in a company's EPS is a sign of growth and in turn helps you. Apart from those, also check their debt history if they're able to handle their debts properly and are able to pay on time. High debt, even on companies, can massively impact their budget due to interest rates. Making sure that they're able to handle their finances properly means that whatever money you put into them gets put into more money-making opportunities for them too. As long as you're able to check whether a company has a good dividend yield, a good PE ratio, and a good financial history, you're good to go and you'll have more information available to you for better judgment. Always remember that being knowledgeable about their industries provides the most context into why their numbers are the way that they are. Understanding the data behind it, the way their industry works, and how most of these can benefit your investments can go a long way. If you've enjoyed this video and found this helpful, please hit the like and subscribe button. We'd like to be able to grow alongside you, and we're pumped to have you in our next video. Stay mentally healthy and let's get financially fit together.